All right, hello everyone. We're just going to give a few minutes for everyone to get settled in here, for everyone to get on, get through any technology issues that they have, kind of logging on. We usually give a few minutes for that, so we'll get started in probably 2 or 3 minutes from now. But welcome and thanks for joining us. Just put a little question up here if while you're waiting. Give us an idea of what matters most to you. Looks like it's slowing down here, but we'll just give it It's like most people have trickled in, but we'll just give it one more minute and then we'll get started. Okay, well, welcome. We'll get started. So, welcome to everyone, and thank you again for joining us. My name is Sean Crockett. I'm one of the partners here at Endurance Wealth Partners. We chose the word endurance because we've brought together a team of highly skilled and experienced financial professionals in every generation from their 20s to their 60s to make sure that as an organization, have the resilience to not only help guide you throughout your lifetime to make sure that you're living the good life, your good life for all of your years, but that we also have the resilience to continue to guide the stewards of your wealth over generations so that your legacy and your impact can be resilient over time. Whether that's wanting to support family, kids, grandkids, whether that's wanting to support the causes that you care about, or maybe it's both of those together, help, and we can help future generations have continue to sort of steward your wealth and have an impact on the causes that both you and they champion. And for most, if not all of you, that is where your legacy and the wealth that you've worked hard for, you want it to go. Most people don't want it all to go to the government. I would say the majority of our clients, their number one intent is not to help fund the government with most of their wealth. Don't worry, some of your wealth will always fund the government. But, what we are here for today is really to talk a little bit about how we can minimize that and get more money to the people and the causes that you care about. And that's why we've invited Lynn Wetham here today to join us. Welcome, Lynn.
Thanks, Sean. It's great to be here.
So Lynn is not only a partner, a colleague, and a friend, but she's also a certified financial planner. She is an estate, legacy, and philanthropic planning specialist. Lynn and I are going to spend the next 20 minutes or so talking about some ideas, some strategies, some tools that you can use to make sure more of your money goes where it's intended. And I'll just share the results from the poll. This is where Most of the people here really intend, it seems a lot of people share the values of EWP. They want to support their local communities. So we're going to share some of those ideas. And then when we're done, I'll say a quick goodbye to those that don't have any questions, and then we'll make sure that we get to everyone's questions. So please just type them in as soon as you have them. So let's get started. Lynn, so you have dedicated your life as a specialist to estate, legacy, philanthropic planning, and as an extension of that, tax is such a big part of that. So, I mean, it's been your life. What excites you about tax and estate planning?
Well, what does excite me? Okay, it's three things: people, legacy, and reaction. First, at Endurance Wealth Partners, we care about the people we help. We take a real interest in who they are and what's important to them. That leads to legacy. We get to help people achieve a legacy that they only dreamed of. With strategic planning, we can take those dreams and turn them into reality. And that leads to reaction. It's the look on their face when they see what's possible to make a far bigger impact by redirecting taxes to charity. What makes this even more exciting is that they can make this impact while significantly reducing their estate, without significantly reducing their estate gift to their families. That's what makes the tax and estate planning exciting, at least to me.
Yeah. And I know we get excited too. We can help people extend their dreams. That's always our goal. We can't, guarantee that, but if we can get ahead of the game and plan, we can get ahead of some of those goals. But let's talk about, you talked a little about redirecting tax. Let's talk about the reality about how much the government can grab from someone's estate, from their financial legacy. So what should everyone here on the line know about what happens to their money from a tax perspective after they're gone?
Well, from probate and capital gains to income tax, estate obligations can really add up. We can see some big tax bills from the registered assets alone, the RSPs and the RIFs. Sean, could you pull up that first slide?
I most definitely can. Just give me 1 second here. Oops. All right, there we go.
So here's an example of a person who has $700,000 in registered assets when they die. For simplicity, we'll use a 50% tax bracket. If they do no planning, their tax bill would be $350,000 and their family would only receive the remaining $350,000.
Wow. So that's a lot of money that's gone to the charity. So 350, half their money's gone.
Yeah.
So I mean that makes sense. So that's a pretty big dip that the government sort of gets their hands into people's money when they pass away. That can be a pretty big impact. Most people want more of that money to go to causes and things that they care and the people that they care about. So why do we encourage people to include a discussion about a charitable gift in their estate planning?
Well, most people think about estate planning as simply writing a will. And they think mainly about the money and the items that they'll leave their family. But they're forgetting something. There's another beneficiary they'd like to ignore, one that they never invite to Thanksgiving dinner. I'm talking about the Canada Revenue Agency, the CRA. For instance, without strategic planning, the CRA may receive half of the value of many people's registered accounts. Revenue Canada can become their primary beneficiary. Using charitable giving in an estate plan is a tool that people can use to leverage more for their legacy. So in other words, you can choose to redirect tax money to a cause you care about. And what many don't realize is that because of the tax treatment, they can make that impact to charity without significantly reducing the amount they leave their family. You win, your family wins, and your charity wins.
So we can basically like you said, redirect tax money to a charity. This sounds great. So I can basically do like, so what do I do? Do I need to write sort of my write the government and tell them, can you take my tax money and put it over here? Like how can taxes be redirected to a charitable gift?
Well, to begin with, the Canadian government recognizes the important work that charities do to add to our quality of life. And in Canada, there are over 20 pieces of legislation that intentionally encourage charitable donations. Our government wants us to be very generous towards charities. They allow you to redirect that tax monies to the charities that matter to you. Let's look at an example that makes use of life insurance. So, Sean, would you bring up that second slide now?
All right, I'll pull that up. Let's go to the second slide. Here we go.
So what we've done here is we've repositioned some of the money from that same registered plan into a life insurance policy that will pay out $500,000 tax-free to the family. If you remember in the previous example, the family would receive $350,000. So we've increased their benefit by $150,000. We make a charity the beneficiary of those registered assets, and that creates a tax credit that eliminates the taxes owing. So in this example, the family has received $150,000 more, and we've made a generous donation of $500,000 to the charity. The use of named beneficiaries in this example also keeps those assets out of probate.
Wow, so more money to the family, and you've also redirected that some of that money to a charity, which gets
And that's why
quite a
I
bit.
get excited.
And that's why, and that's a good reason to get excited. Everyone should get excited. So, and excited that, I mean, who knew the government does have some generosity, right? So, I mean, maybe not directly, but by encouraging us to be generous and giving us the tax break, it can really help. So, can you give any other important examples of sort of government generosity?
Oh, yes, I'm happy to give another example. Here's a major opportunity that many people don't take advantage of, the donation of appreciated securities. If you own a stock or mutual fund outside of a registered account that's grown in value, there would be tax on the growth of that stock when you sell it. It's called a capital gain. Half of the growth is added to our income and taxed at our marginal tax rate. Oftentimes, we hold on to these stocks because we don't want to trigger that capital gain. Now, if you donate the actual stock to a charity, you don't have to pay the capital gains tax, and you still get a charitable tax receipt for the full amount the charity receives. So you save taxes twice by choosing the security as your gift. This is an important concept. So let's look at a comparison. Sean, would you pull up that third slide?
Right with you here. Number 3, here we are.
We'll make some assumptions here. Let's assume that you've decided to make a donation of $100,000 because that's a nice round number and the arithmetic is easy. We'll use a 50% tax bracket. And let's say that you've owned it for years and you paid $10,000 for it. If you sold the security first, you would pay $22,500 in capital gains off the top. The leftovers would be the donation to the charity, and you'd get a charitable tax receipt for $77,500. And that would save you $38,750. The $100,000 of stock gave the charity $77,500 because the rest went to tax. After the tax savings, the gift would only cost $61,250.
Wow. So, okay. So if to just to review this sort of, If we decide to donate to the charity, I have 100,000 in that security. When I sell it, have to pay 22,500, which is
Right.
only going to leave me 77,500 to give to the charities. The charity's not going to get the full 100,000. They're only going to get the 77.5, which means we only get a tax receipt for the $77,500.
Correct.
Okay.
But Sean, there's a better way. Um, it's more beneficial to the charity and to you as the donor if you make a gift of the stock itself. This would mean that you pay no capital gains tax. You get a charitable tax receipt for the full $100,000 and save another $50,000 of tax. The charity receives the full $100,000 and the actual cost to you is only $27,500 this time.
Okay, so in this case, same security. I can give the whole thing just as it is, whether it's units of a mutual fund or whether it's a stock. I just give it as it is to directly to the charity, which is something EWP can facilitate. So in this case, charity still gets the full $100,000, which is a benefit to the charity.
Mhm.
We get the full $100,000 tax credit, but we never had to pay any capital gains tax.
That is correct.
All right, so you're significantly ahead there.
Absolutely. So it's possible to transfer the asset directly to the charity, and neither you nor the charity have to pay the capital gains tax. You still get a tax credit for the full $100,000 that the charity receives. So don't sell the stock or mutual fund. You have to transfer it in kind to the charity. And I've used that $100,000 here for a round number. It'll work for any amount. And remember, the charity doesn't pay capital gains, so they keep the $100,000 to run their programs. And this is a strategy that works while you're alive or for your estate.
So either way,
Yep. So either in both examples. And now this is a special process, and your Endurance Wealth partner can help you with that. First, to identify the investment that has the capital gain, and also with that special process. They'll show you how important this is for your estate planning, and they'll show you how important this can be for your annual tax planning. So, as an example of the government's generosity, this is a fantastic strategy. Use it in your estate and use it while you're living.
I know it's something that I'm using now to make sure that, instead of donating cash to charities, I've got securities with appreciated value. Might as well get rid of that capital gain. And the cash that I would normally generate, I can just reinvest in a security. So it makes a whole lot of sense. Now, a lot of the people that we work with, obviously, their first intent with a lot of their money is to make sure that their lifestyle is supported throughout their life. So how can we be confident when we are giving our money away?
Well, we should start with what we call a generosity plan. We really shouldn't start giving our money away, not to charity or to our kids, without first knowing that we have enough for ourselves. Your Endurance Wealth Partner advisor can do some projections to show you if there's any chance of you running out of money. They can run different scenarios for you. I call these what if plans, and they can help you make confident decisions.
And we as a team use what if plans all the time to make sure, again, through someone's lifetime to make sure no matter what happens, there's a high probability chance that they have the money they need to live that good life throughout their life. But are there other ways that what if plans can help in decision making?
Yes, okay. So, what if plans can help you be confident that you won't outlive your money? They can model different scenarios that answer the questions, what if I give my money away now? And what if I give a gift from my estate? They can show which assets are most advantageous to give to charity and which are most effective to give to your family. This answers questions such as, what if I give my kids my house? What if one of my kids wants the house? What if another one wants the cottage? What if I give charities my stock? How can I make that fair? And how does that look?
Yeah. So, I mean, there's really different decisions here now that we've got to think about, which is not just, what do I want to leave in my estate, but, now I'm thinking about now when the charities need the money, do I want to give it to them now or later? So how should people decide whether to give more now or to plan to give more in their estates?
Well, primarily, it can be a personal preference. Some people want to see the results of their gift and prefer to give while they're living. They want to see the immediate effect of their donation. So, after personal preference, it becomes a tax consideration. Some people need the tax relief now while they're living, and some people need the tax relief when they're gone for their estates. Some of you need both. And this is an area where your Endurance Wealth Partner Advisor can help you determine the most beneficial solution based on personal preference and tax considerations. Those what if plans help in all these scenarios.
Yeah, so really a lot of what if scenarios to do there. And we've kind of opened up a different area now. We were talking about the estate and what might work there, but for clients that want to give a living gift, I know that you've worked with many individuals and have helped them set up donor advised funds. So, how do these funds fit into a plan and why would we recommend them? Like what advantages do they have?
Yeah, so the easiest way to think about a donor advised fund is to think of it like a family foundation. So in the past, family foundations required considerable cost to set up and administer, and they were complicated. So the donor advised fund simplifies all that and allows you to make one contribution and then direct the funds to the charities that you wish to receive your donation. The single tax receipt is especially helpful for people who give to a long list of charities. It helps at tax time and it's flexible. You can choose to set it up during your lifetime. You can choose to let it accumulate or to pay out larger amounts. You can use it during your lifetime and or as an estate planning tool. You make one contribution, the administrator provides one tax receipt, simplifying your process and reducing your income tax. You instruct the donor advised fund where to give money and when.
So the donor advised fund is like a charity in itself. Once you make the donation, I mean, and then it can give out to the other charities. So it can help us plan sort of timing between when we need the tax breaks and when we want to send stuff to charities. Now, I earlier referred to sort of working with your family to help support the causes that you care about and they care about. So, in what ways can a family be included in a generosity plan?
Well, some people choose to include their family in the decisions about their giving, and they create a generosity plan with input from their families. I've seen grandparents ask their grandchildren about what causes they think are important, and then allow them to allocate a certain amount of money annually. A generosity plan makes it clear how you want to pass on your values. Part of the generosity plan could be a donor advised fund. It's an opportunity to include the family in the decision making. In fact, you can name the fund. It could be your family name, or it could be that someone that you want to honor. After you're gone, the donor advised fund can be instructed to follow your instructions or to receive ongoing instructions from a family member.
Wow, so it's really something the whole family can kind of get involved in, and we can sort of I know that's something I've been thinking about to encourage our children's generosity in the future and to think
Mhm.
about those in need. So it's really a way to get everyone involved. So a lot of advantages here of donor advised funds. I mean, we can help with the timing. You can get the money in there, get the tax receipt right away, and use it as you will, and give to charities, when it seems most appropriate. Get the family involved. Are there any other advantages of donor advised funds?
Yes. And here's a question I'm asked quite often, and it goes like this. I have three charities that I want to make a gift to in my will. Well, what if I change my mind? Or the organization changes or ceases to exist? Or I want to add another charity. Am I going to have to change my will? The donor advised fund is a good solution because you make the donor advised fund the beneficiary of your estate gift, and then you can simply change your instruction to the administrator of the donor advised fund when you review your plans.
Okay. Okay, so we've talked about quite a few different ideas here on, different tools, different strategies people can use to help make sure that more of their money gets directed to the people and causes that they care about. And the government, they fund the government as little as possible, if that's a good way of saying it. They don't get as much of their
Sure.
hands on it. There's certainly a lot of other strategies out there that your EWP advisor would know about and would bring into play here. So I think we've given enough for people to sort of start thinking, get their juices flowing. So the next time they reach out to their EWP advisor or they sit down with their EWP advisor, they can have a little bit of a conversation, at least get the conversation started and plan a lot of those things. But maybe before we sort of end things out, um, you know, for everyone here, why do people sort of need to take action on that planning now? And what are sort of the next steps for the listener if they do want to take action?
Wow, that's a really important question. Sometimes people believe that they'll just leave this up to their executor. The thought is, oh, my kids will know what to do. The executor will know what to do. Here's the thing. Executors play a vital role in administering an estate, but their authority has very strict limits. Most decisions, particularly those with tax implications or charitable impact, must be made by you while you are still alive and capable. Several times in the last year, I've spoken with executors who wanted to make charitable gifts to reflect a loved one's values, but sadly, I had to inform them that the chance for tax relief for the estate had passed. The executor cannot take advantage of the tax savings unless it's in your will. So ask questions, explore the possibilities. The decisions you make today carry your values forward. So I urge you, take action now. Follow through with the things you're thinking about today. Talk with your Endurance Wealth Partner advisor and get some help and have a conversation.
Yeah, and I would sort of encourage everyone, of course, to do that, to reach out to their Endurance Wealth Partners advisor about this or any other ideas. We shared a few today. There's a lot of other strategies. In fact, if you're interested in having a webinar like this or a broader conversation about some other strategies, whether that's around estate planning, it's hard to cover them all in one webinar. We might be here for hours and hours. It's easier to kind of split these up into specific sort of subjects. We would be happy to tackle that. So please do. So for anyone else who has questions about anything that we've talked about today, I will say this video will be recorded, so you'll be able to watch it again. But for those who do have questions, please, there's the Q&A button at the bottom. I'm already seeing a question or two in there, so please just type in your questions. Let us know if you're interested in uh, anything, if you have any more questions. But before those that don't have questions, before we end here, I would just like to say a few things to those that are going to leave. Anyone who has questions, please stick around. But to any of you before you leave, I would just simply say, whatever your situation is, planning and doing advanced planning, as Lynn has alluded to here, can ensure that your money goes where you want it to and doesn't go to places that you don't want it to, like funding the government. Again, you're always going to do some of that. You just don't want to do too much of that. And there are not just strategies we've talked about today, but there is a vast amount of strategies I've alluded to that your EWP advisor can help you figure out. So you really don't have to do this alone. There are over a dozen advisors at EWP who understand these and all sorts of strategies. We work together to help maximize your plan. And all of them are backed by an even larger team of accountants and lawyers and specialists, internal here at Assante, and external specialists that we consult with on a regular basis. You are literally surrounded with help. All you need to do is ask. So I just put up a poll question a little while ago. If you are interested in having someone reach out to you, and you haven't already noted that earlier, please note it there. Or you can reach out directly to your EWP advisor. Or if you don't have an EWP advisor, then all you really need to do is go to www.endurancewealthpartners Canada. That's important because there's an Endurance Wealth Partners in the US and they can't help you. So endurancewealthpartnerscanada.com. There'll be a contact button right up on the right-hand side, or you can just email us directly at endurancewealth, all one word, at assante.com. And we would be more than happy to make sure we reach out to you and start this planning process so everything's in place while we have time to put everything in place to ensure everything's there. Or you don't even have to reach out to us because if you already have an Endurance Wealth Partners advisor, they're going to be asking you these questions as they have in the past when they sit down and make sure they incorporate all of this in your plan. So for those that don't have any questions, I will say thank you very much for joining us. We look forward to hosting you at another one of our webinars. Those that do have questions, will stick around for a little bit. Just give me a few seconds here. Lynn's going to stick around. I'll stick around to answer any questions. If you have anything, please type it in now. We'll answer these as we can, as they come up. Whatever questions that we do have, I'm just going to look through these quickly, and we will get ourselves started with a few questions. So Lynn, we someone's asking, obviously has some U.S. tax implications, whether that's I mean, you can have U.S. tax implications for several reasons. If you have assets in the U.S., that could affect things depending on your total estate size. If you are a U.S. citizen, then you are taxable. The U.S. is one of the few countries that actually taxes outside of its borders. So that's something important to think about. If you have any of those connections, there can be U.S. tax implications. The questions here, is there any thoughts about those U.S. tax implications?
There are definitely thoughts, Sean.
Okay, all right.
And the thoughts are that the planning is of utmost importance because of those U.S. connections. U.S. assets, U.S. citizenship, those things really complicate the estate. Some people are worried sometimes because they have a beneficiary in the States. I mean, have a conversation about that, but the big ones are those assets in the States, and we have folks who can look at each of those U.S. assets and tell you, the best way to handle them. So again, that's that larger team, the accountants, the lawyers. We have the resources there for you to go to get the answers regarding those U.S. connections. And I urge you to do it. Again, ask the questions, have the conversations. It's really important.
Yeah, and I think if you are a U.S. citizen, like if you still carry U.S. citizenship, I would encourage that you should have a U.S. tax specialist that you work with. I think that's very important. U.S. tax law is very, very complicated. So a good
Well,
cross-border
and it's not
specialist.
the same in each state.
Yes, yeah. So it really depends. So having a specialist is I think very important. That's something we can help advise you with, but that's something we would encourage. The implications can be so broad that you really have to dive down to your individual situation. So that's a conversation for your EWP advisor, and we can bring in some specialists and get you hooked up with the right specialist for sure. So Fran and Eric, I would just say a book is on its way. You will get that, no problem. There is also a question about a last to die insurance policy and how that might play into some of the scenarios. Lots of different ideas we could come up
Yeah,
with there as well.
we make a lot of use of joint last to die insurance policies. Um, the why we would use that type of insurance policy is it pays out on the second death, and that's when all these tax implications happen. So it pays out at the right time. Because it's a joint policy that only pays out on the second death, um, the pricing is better as well. So it's often our go-to, and most of these strategies that use life insurance could make use of that joint last to die. So sometimes people have one, and we just have to figure out, what the best use of that is. Um, and we often place new insurance to make use of these strategies. But yes, the joint last to die is a very valuable tool in estate planning.
Yeah, and we have an insurance specialist team that we work with. Jay and Maria are fantastic and sort of that they can link in on how to use that best, look at what you have currently, look if it's structured the best way to make sure it's meeting all your needs and all that kind of stuff, and look if there's anything that we need to change about. So again, it all comes down to everyone's individual situation, sitting down with your EWP advisor, going through sort of the scenario and bringing in the experts that can help you. Last question we have here is, unless someone types a question in the meantime, was how to get a copy of this session. So that's a great place to end off, actually. So again, I put up earlier our website at www.endurancewealthpartnerscanada.com. So this just needs to go through the lawyers before we can post it on there. So it does take a few weeks. Lawyers don't move fast. But in a few weeks, we'll have it posted up on the website and you'll be able to watch the replay from it at your leisure. So I think those are all the questions.
And their endurance wealth partner advisor can also make sure they get a book if they've if they didn't request it here, we can their advisor can make sure they get one as well.
Yeah, and if you reach out to your advisor or email us or whatever and just let us know, we'll let you know when it's up available on the website, and they can double check if you want a copy of the book as well, which will go into a lot more in depth on some of these concepts and a lot of other concepts. Yeah.
And I said we should say that the book is a real easy read. It's not a put your head in a vice kind of thing. It's a book that you can easily read over a weekend if you choose to. It's more stories, and it's a light read. It's not a technical book. So if the idea of a book on estate planning scares you away, it's not really a scary book.
Yeah. I would agree as well. All right. Well, those seem to be all the questions. So, if anyone thinks of a question later on that they really want to ask, please just reach out to your EWP advisor, or you could email endurancewealth at assante.com, and we'll make sure that your question gets answered and someone gets back to you on that. If you haven't indicated already as well that you would like someone to contact you, just reach out and we will make sure we do that. But with that, I would like to thank you, Lynn, very much for sharing your wealth and a lifetime of knowledge with all of us. I know there is a lot more there, but in order to make this bite-sized for everyone, it's good to stay with a few strategies. And we look forward to having more of these in the future. Anyone have any ideas, please reach out to your Endurance Wealth Partners advisor, or like I said, endurancewealth at assante.com. Give us ideas. We'll run the webinars and make sure the information's here for you. Thank you very much, everyone, and have a fantastic evening. Thanks again,
Good
Lynn.
night.
Good night.